How do crypto whales affect the price and why should traders follow them? Hello, fellow traders. Cryptocurrencies are increasingly entering our lives. In today's article, we will touch on a very interesting topic related to large holders of relevant assets, primarily bitcoins. They are called crypto whales. We will analyze who they are, how to track their actions, and also try to benefit from this information. As usual, it is difficult not to notice a new trend in the Forex market cryptocurrencies in the lists of instruments at brokers. On an international scale, there are no more than 20% of Forex companies trading cryptocurrencies, but in a year we are waiting for a kind of Cambrian explosion. It consists in a sharp increase in the number of brokers that support digital currencies, the number of types of cryptocurrencies in the offered tools, the number of types of derivatives and, most importantly, the appearance of CFDs on a variety of crypto indices. The world's largest investment banks have decided to publicly support the trading of digital assets, which will appear at the liquidity providers and will automatically become available to the clients of currency brokers. Many of us have a negative attitude to these tools for various reasons. They are difficult to understand in technical terms, their growth is similar to a hype, and the volatility significantly complicates the use of indicators for intraday trading. There is no need to talk about fundamental analysis at all. Today there are no separate economic indicators for Bitcoin and altcoins. Despite the above disadvantages, there is one important feature that is present in almost every cryptocurrency. It greatly simplifies the analysis, forecasting of the movement of a digital asset and trading. The distinctive feature of the cryptocurrency is the availability and transparency of all actions and transactions of large investors, which is considered an insider in traditional markets. Digital currencies, like the national currencies of Forex, called in the slang of crypto traders, fiat, are only part of a complex ecosystem. Unlike Forex, cryptocurrencies do not have central banks. Their monetary policy is determined by the blockchain algorithm or the digital democracy community, DAO, where each coin owner has the right to vote on certain conditions. This is called the digital currency ecosystem, which includes mining method, type of consensus, etc. Unlike fiat, the rate of which depends on the words and actions of representatives of the Federal Reserve, the ECB and other global financial regulators, inflation, the size of the issue and even the distribution of coins in the hands of every internet user is known in advance. The code of any cryptocurrency is openly posted on the developer's website or on GitHub, the largest web service for programmers, where the final issue and the rate of release of blocks with new coins are registered, allowing you to calculate inflation. The same information in a simple and accessible form, along with price statistics, can be found on the CoinMarketCap website. By clicking on the name of the cryptocurrency of interest, you can see in the card that opens, for example, Bitcoin. Total issue size and number of coins issued. Official website address. The blockchain browser. The latter tool helps to determine not only the speed of block assembly, but also shows the transaction history of each coin, the deposit size of each wallet, and the movement of the digital currency as a whole. The main principle of the cryptocurrency blockchain is full publicity and transparency, which opens up the opportunity for anyone to calculate the actions of crypto whales and holders. Crypto whale. Crypto whales, holders of cryptocurrency with large amounts of coins in their wallets. Holder, owner, is a more general concept that applies to all traders who use the buy and hold strategy. Unlike Bitcoin, a number of cryptocurrencies have involuntary holders. They are forced to freeze the funds for a certain period of time as a pledge, stake. This guarantees their integrity when confirming transactions due to the risk of losing funds in the event of manipulation. Thus, stakers are a certain type of miners who receive a reward for assembling blocks with cryptocurrency transfers in exchange for a share of the cryptocurrency placed as collateral. If Forex traders are forced to analyze the glass or wait for the Friday release of COT reports, then on most digital currencies, it is not difficult to track the actions of the owners of large accounts and the movement of crypto capitals. In this regard, the blockchain really serves as an open book of all transactions in real time. The exchange rate of a single cryptocurrency, like a stock, depends on the number of free float assets in free circulation. Crypto whales, as a rule, collect coins in the wallet for the purpose of a long-term hold, justified by the history of the growth of the exchange rate of digital currencies, which can be estimated by the dynamics of their total value. According to the statistics available on the CoinMarketCap website, it is clear that the market capitalization 8 years ago was $1.63 billion. Now the value of all assets is 1,000 times more. It is accumulated by 45% in Bitcoin and by 25% in the first 3 major altcoins. The 1,000-fold growth of cryptocurrencies has made crypto deposits into convinced holders, who create a free float deficit in the market with their purchases of assets and their retention, pushing the exchange rate to new heights. And for the same reason, digital currencies with a blockchain, where a stake is provided, are growing. The desire to make money on the freezing of the cryptocurrency increases the rate due to active purchases of it on the market. Staking often encourages the appearance of crypto whales, because it is the size of the deposit share according to the blockchain algorithm that guarantees a higher frequency of receiving rewards. The increase in the balance of CryptoKit wallets serves as a signal confirming the current growth of the cryptocurrency market, but does not give traders an advantage in the form of a leading indicator. It is much more important to monitor the behavior of large holders at the time of the fall of the cryptocurrency market. If a decline in the exchange rate leads to a decrease in the deposit of crypto whales, put a stop loss as close as possible to the held position or try to get out of it. Selling crypto whales can lead to a market collapse. An active increase in deposits at the addresses of whale wallets at the time of the market decline indicates the proximity of the bottom. Of course, you should not expect an instant reversal when the described divergence appears. The trader should break his entry into parts and be ready to average the position. Large wallets can be found in the statistical collections of blockchain reviewers. These are special services that contain not only the history of all transactions, but also an additional set of their own research. For example, on the BitInfo Charts website, large addresses are located in the Explorer section. In the cryptocurrency market, institutional clients are most informatively represented in the Tether system, which issues USDT tokens pegged to the US dollar, and the Grayscale investment fund trusts. Despite the relatively small share of investments, just over $100 billion, statistics show that these capital movements in the form of Tether issues often occur before major trends or a reversal of the digital currency market. Tether is notable for working directly with major OTC services in China, buying up 68% of the USDT token issue. It leaves in large batches of several hundred million for one tranche. The moment of the release of a large issue can be tracked in the Whale Alert service. Be careful. I am interested in the fact of issuing new coins, and not any transactions. Such messages are provided with a sign in the form of bundles of money and the word, minted. The market begins to grow steadily literally the next day after the issue is printed. It is worth reacting to the issue of lots of $1 billion USDT per day. Anything below this threshold may not trigger growth in the cryptocurrency market. Sometimes, especially when the digital asset price falls, the issue causes an increase for 1 or 2 days. The trader must protect his paper profit with a stop loss if Tether's efforts are not enough to create a full-fledged trend. Grayscale is the largest investment fund that has been issuing trust units backed by real cryptocurrency for 7 years. The company has licensed 14 crypto trusts in the United States, which are available only to professional investors who are ready to invest at least $25,000 for 6 months or a year without the right to withdraw funds. An alternative option for retail investors is to buy shares of these trusts on the OTC market, issued for the amount of cryptocurrency purchased with the investment of institutional clients. Grayscale has received 3 licenses from the U.S. Securities Commission to issue shares in 3 trusts: Bitcoin, Ethereum, and Litecoin. The company conducts a completely transparent business, Publishing daily reports on Twitter, skipping only the days when there is no outflow of funds in the funds. You can track the actions of crypto whales by the last column of daily changes. If they are above 5% for BTC and 10% for other cryptocurrencies, the trader should think about opening a long.